Welcome to Wealth Hustle 247 podcast, your trusted guide to financial literacy, business innovation, and entrepreneurial success. Learn how to grow your wealth, make informed decisions, and turn your ideas into profitable ventures.
Confused by financial terms? In this episode, we break down the ABC of financial jargon and their meanings, making money talk simple and clear. Let's dive right in.
Okay, let's be real for a second.
Yeah.
Finance can feel like, I don't know, like a whole other language sometimes.
It's true.
Right. It
Yeah.
really can.
Yeah.
You open up some financial report or something and you're like, wait.
You need a decoder ring.
Yeah, exactly. It's like, where's my decoder ring?
Exactly.
I don't know what any of this means.
It can be really daunting, even for those who,
Right.
feel like they're familiar with the basics.
Yeah, so that's what we're doing today, like a deep dive into a glossary of financial terms, but not just like defining them, but really kind of exploring how they actually play out in the real world.
Absolutely.
From everyday personal finance
Right.
to like the decisions of big companies to global trends.
Yeah.
Like we're going to kind of uncover like the kind of surprising backstories behind these terms
Yeah.
and how they connect to the bigger picture.
For instance, did you know
Yeah.
that the U.S. government's fiscal year
Yeah.
actually starts on October 1st? Not something that most people think about,
Yeah.
but it has a significant impact on
Right.
how budgets are managed and
I mean,
how economic data is analyzed.
that's a great point.
Yeah.
And it highlights how like these seemingly like obscure
Yes.
terms can actually like reveal a lot about how things work.
A lot of things behind the scenes.
Yeah, exactly. So get ready to unlock some serious financial fluency.
Absolutely.
You might be surprised how relevant this stuff is to your everyday life.
Absolutely. Understanding these terms can empower you
Yeah.
to make more informed decisions about your own finances, your career, and even,
Absolutely.
your understanding of the world around you.
Yeah, for sure. Okay, let's jump right in.
Okay.
One term I always hear is assets.
Yeah.
And it seems like everything in finance kind of revolves around that.
It's true.
But it's more than just like your house or your car.
You're right. It's much broader than that. An asset is anything you own that has value, from the cash in your wallet
Right.
to the expertise you bring to your job. Even a company's brand reputation can be considered
Oh, wow.
an intangible asset because it adds value
Yeah.
to the business.
So a company's reputation being an asset.
Yeah.
That's interesting. How is that value actually measured?
That's a great question.
Yeah.
It's a tricky one to quantify.
Yeah.
But in mergers and acquisitions, for example,
Right.
a premium is often paid for companies
Yeah.
with strong brands and loyal customer bases.
Oh, interesting.
That premium represents the value of those intangible assets.
Gotcha.
There are methodologies to estimate brand value,
Right.
but often comes down to
Yeah.
complex calculations involving future earnings potential
Yeah.
and market perception.
So even though you can't like physically touch it,
Right.
it can still have a very real impact
Very real.
on a company's bottom line.
Precisely. And that's why understanding the different types of assets, tangible, intangible financial value, is so crucial for both individuals and businesses.
Yeah, that makes sense.
Yeah.
Another term that comes up a lot with assets is equity.
Yes.
How does that fit into the picture?
Equity represents ownership. Think of it like this. If you own a house worth $500,000,
Okay.
but you have a $200,000 mortgage,
Right.
your equity in the house is $300,000.
Oh, okay.
It's the portion of the value
Gotcha.
that truly belongs to you.
So in a business context, would equity be like the portion of the company that like
Exactly.
the shareholders own?
It's the value that remains
Okay.
after deducting all liabilities or debts.
Okay.
And this is where things get interesting.
Okay.
Companies can raise capital by issuing more shares,
Right.
which dilutes the ownership percentage
Okay.
of existing shareholders.
Interesting.
This is a constant balancing act for businesses,
Yeah.
raising the funds they need to grow while also considering
Right.
the impact on existing investors.
Yeah, it's like baking a bigger pie, but each slice might get a little smaller.
That's a great analogy.
Yeah.
And it highlights why investors pay close attention to a company's equity structure
Yeah,
and how it changes over time.
that makes sense.
Yeah.
Speaking of pie, let's talk about capital.
Okay.
Is that just a fancy word for money?
Well, it's broader than that.
Okay.
Capital is any resource that can be used to generate wealth.
Okay.
It can be financial, like cash or investments,
Right.
but it can also be human capital,
Human capital.
the skills and knowledge
Right.
that individuals bring to the table.
So if I'm like a skilled programmer,
Yeah,
my coding ability is a form of capital.
absolutely. And the more you invest in education, training, and developing your skills,
Right.
the more valuable your human capital becomes.
Oh, that's fascinating.
It's not just about the money
Right.
in your bank account, but also
Right,
about
right.
the knowledge and abilities
Yeah,
that you bring to the marketplace.
for sure. Okay, so we've got assets, equity, capital.
Okay.
How about amortization, which I always think about when I'm like paying off my mortgage.
Yeah.
But what's like the underlying concept there?
Amortization is essentially the process of spreading out
Okay.
a loan payment over time.
Right.
Instead of paying back the entire loan
Yeah.
in one lump sum, you make regular payments that include both principal and interest.
So it's like slowly chipping away at it over time.
So that's a good way to put it.
Yeah.
And what's interesting is
Yeah.
how the proportion of principal and interest
Okay.
changes over the life of the loan.
Oh.
In early years, you're mostly paying interest,
Right.
but as you make more payments,
Yeah.
a larger portion goes toward the principal,
Okay.
and the loan balance decreases faster.
So that's why in the beginning it feels like you're barely making a dent.
Exactly.
Yeah.
Understanding how amortization works can help you make
Yeah.
more informed decisions about loans, whether it's a mortgage, a car loan, or even a student loan.
Right.
It helps you see the long-term implications of your borrowing decisions.
That makes a lot of sense.
Yeah.
Okay. How about arbitrage? I feel like when I hear that word, I picture people in suits.
Yeah.
Like, making millions of dollars.
It has a certain mystique to it, doesn't it?
Yeah, it does.
But at its core, arbitrage is simply exploiting price differences
Okay.
for the same asset in different markets.
So if I find like a rare book in a dusty old bookstore for $10,
Yeah.
and I know I can sell it online for $100,
Yeah.
that's arbitrage.
You got it.
Yeah.
You're buying low and selling high to profit from the price discrepancy.
Right.
But in reality, those opportunities are rare
Right.
and usually short-lived.
Yeah.
Markets are efficient at correcting those imbalances.
So it's not quite the get-rich-quick scheme.
Not usually.
Yeah.
And keep in mind that any form of arbitrage comes with risks.
Okay.
You need to factor in transaction costs, market fluctuations,
Yeah.
and the possibility that the price difference might disappear
Oh, of course, yeah.
before you can complete the trade.
Okay, so while it might sound glamorous, it's a little bit more,
It's more complex
Complex.
and nuanced
yeah.
than it appears on the surface.
Yeah, it's not a guaranteed path to riches.
Precisely.
Hmm.
It requires careful analysis, timing,
Yeah.
and a good understanding of the markets involved.
Okay, before we dive into the next batch of terms,
Okay.
let's recap what we've covered so far.
Sounds like a plan.
We started with assets.
Yeah.
Which is like anything of value that you own,
Right.
from tangible items
Yeah.
to intangible concepts like brand reputation.
Exactly.
Then we explored equity, which is about ownership
Yeah,
and how it plays out in both personal and business contexts.
absolutely.
We learned that capital is more than just money.
It's any resource
Yeah.
that can generate wealth, including human capital,
Right. Our skills and
for
knowledge.
its skills and knowledge.
We demystified amortization,
Yeah.
which is spreading out a loan payment over time.
Over time, exactly.
And we explored the concept of arbitrage, which is like exploiting price differences in different markets.
Exactly.
I'm feeling more financially fluent already,
Me too.
but there's a lot more to learn.
There is.
So let's see what other intriguing financial terms are waiting to be decoded.
Let's do it.
All right.
All right. Welcome back to our deep dive
Part 2.
into the fascinating world of financial jargon.
Well, yeah,
Ready to decode some more terms?
absolutely. Yeah. I'm feeling like we're like cracking the code of Wall Street
I love it.
one term at a time.
One term at a time.
What's next on our agenda?
Let's delve into the realm of bonds,
Okay.
a term often thrown around in investment discussions.
Yeah.
Have you ever wondered what exactly a bond is and how it works?
I've always been a little intimidated by bonds.
Really?
Yeah.
Why is that?
I don't know. They seem kind of shrouded in mystery, like
Yeah.
all this talk about yields and maturities and all that stuff.
I understand.
Yeah.
Bonds can seem complex, but the basic idea is actually quite simple. When you buy a bond, you're essentially lending money to an entity. It could be a government, a corporation, or even a municipality.
Right.
In return, the issuer promises to pay you back.
Okay.
The principal, the original amount you lent, plus interest
Okay.
over a predetermined period.
So it's like I'm becoming a mini bank,
You've got,
lending money and collecting interest.
and just like with bank loans, bonds come with varying levels of risk.
Okay.
Government bonds, especially those issued by stable governments,
Yeah.
are generally considered low-risk investments.
Okay.
Corporate bonds, on the other hand,
Yeah.
carry more risk
Right.
because a company's financial stability can fluctuate.
Oh, okay. So there's like a trade-off then
Exactly.
between risk and reward.
Right.
Like the safer the bond,
Generally,
the lower the
or
return.
the lower the potential return, yeah.
Okay.
Investors who seek higher potential returns might opt for
Yeah.
riskier bonds issued by corporations with lower credit ratings.
Okay.
These are sometimes referred to as high-yield bonds,
Right.
or more colorfully, junk bonds.
Your bonds, that sounds a little...
A bit of a gamble.
Yeah.
It can be.
Right.
But even with riskier bonds, there are ways to mitigate the risk.
Okay.
That's where diversification comes into play.
Diversification.
And our old friend from earlier.
Spreading your investments
Right.
across different asset classes to reduce risk.
Exactly.
Yeah.
Instead of putting all your eggs in one basket,
Right.
you diversify your bond holdings by investing in bonds
Okay.
from various issuers, industries, and maturities.
Gotcha.
This way, if one bond performs poorly, the others can help cushion
Right.
the impact on your overall portfolio.
So even within bonds, there's a whole spectrum of risk and reward to consider.
Absolutely. And understanding those nuances can help you create a bond portfolio that aligns with your risk tolerance and financial goals.
That makes sense.
Yeah.
Okay, shifting gears a bit.
Okay.
I'm curious about the term derivatives. It just seems like a word that gets thrown around a lot,
It does, yeah.
especially when talking about...
More complex financial instruments.
Yeah.
Derivatives can be a bit of a head scratcher.
Right.
But the core concept is actually not that complicated.
Okay.
A derivative is a financial contract that derives its value
Okay.
from an underlying asset, such as a stock, bond, commodity, or even an index.
So it's kind of like a side bet
Yeah,
on the performance of something else,
you got it.
like wagering on whether like the price of gold will go up or down.
That's a good analogy.
Okay.
Think of it as a contract that allows you to speculate
Right.
on the future price movements of an asset without actually owning the asset itself.
Gotcha. But what makes derivatives so complex then?
Their complexity stems from the variety
Okay.
of derivative types and the strategies used to trade them. There are options, futures, swaps, and many other variations, each with its own set of rules and risks.
So the basic idea is kind of straightforward.
Yeah.
But the details can get pretty intricate.
Exactly.
Right.
And the level of leverage
Right.
that derivatives offer
Yeah.
can amplify both gains and losses, which is why they're often associated with higher risk.
Leverage, that's another term we've encountered.
It's right.
Using borrowed money to
Amplify.
amplify potential returns,
Yes.
but also increasing the risk.
Precisely.
Right.
Derivatives can be powerful tools for sophisticated investors,
Okay.
but they're not for the faint of heart.
Definitely not. Okay, balance sheet.
Oh,
Another one I've heard, but I'm not always sure what it contains.
a balance sheet is essentially a snapshot
Okay.
of a company's financial position
Right.
at a specific point in time.
Gotcha.
It provides a summary of the company's assets, liabilities, and equity,
Okay.
allowing investors and analysts to assess its financial health.
So if I want to get like a quick overview of how a company is doing,
Yeah.
I should check out their balance sheet. Exactly. The balance sheet follows a simple equation.
Okay.
Assets equal liabilities plus equity.
Right.
It helps you understand how a company's assets are financed,
Okay.
either through debt, liabilities,
Right.
or ownership, equity.
Okay, so it's kind of like a financial report card
It is.
that shows what they own, what they owe,
That's right.
what's left over for the owners.
That's a great way to put it.
Yeah.
And by analyzing balance sheets over time,
Yeah.
you can track trends in a company's financial performance,
Right.
see how its debt levels are changing, and assess its overall financial stability.
That makes sense. Okay, market capitalization.
Wow.
Sounds kind of massive.
It does sound massive, doesn't it?
Yeah, and intimidating.
But what does it actually mean?
Yeah, what does it mean?
Market capitalization, or market cap for short,
Okay.
is simply the total value
Okay.
of a publicly traded company's outstanding shares.
Okay.
It's calculated by multiplying the company's share price
Right.
by the number of shares outstanding.
So if a company has 1 million shares outstanding and each share is trading at $50,
Yeah.
their market cap would be $50 million.
Exactly.
Okay.
Market cap is often used to categorize companies by size.
Okay.
Small cap, mid cap, and large cap.
So a company like Apple, with its ginormous market cap,
Right.
would be considered a mega cap company.
That's right. And market cap can be a useful metric
Right.
for investors when comparing companies
Yeah.
within the same industry or sector.
Right.
It gives you a sense of the relative size and scale
Right.
of
Right.
different businesses.
That makes sense.
Yeah.
Okay. Recession.
Oh,
A word that everyone dreads,
Yeah,
but it's important to understand what it means.
absolutely. A recession is a significant decline in economic activity
Okay.
that lasts for more than a few months.
Okay.
It's typically characterized by negative GDP growth,
Right.
rising unemployment, and a decrease in consumer spending.
So it's not just like a few bad days on Wall Street.
Bro.
It's like a sustained period of like,
Of economic contraction.
yeah.
Exactly.
Yep.
And while recessions are an inevitable part of the economic cycle,
Right.
they can be triggered by a variety of factors.
Yeah.
From financial crises to global pandemics.
So even though we can't predict exactly when they'll happen,
Yeah.
we know that they're like a recurring.
They're a recurring phenomenon
Yeah.
in economic history.
That makes sense.
Yeah.
Okay. Hedging
Okay.
sounds like something you'd do with a garden,
It does. It does.
but it's obviously a different concept in finance.
Hedging is a risk management strategy
Okay.
that's designed to offset potential losses from investments.
Okay.
Think of it like insurance for your portfolio.
So if I'm worried about like the price of a particular stock going down,
Yeah.
I can hedge against that risk.
Exactly. There are various ways to hedge,
Okay.
but one common method is using derivatives,
Okay.
like options or futures contracts.
So by using derivatives strategically,
Yes.
you can potentially limit your losses if your investments don't perform as expected.
That's the idea.
Okay.
Hedging is all about managing risk
Right.
and protecting your portfolio from adverse market movements.
Okay. That makes sense. Inflation,
Oh, yeah.
a term that seems like particularly relevant right now.
It is a hot topic,
Yeah, it is.
but I'm not always sure what it really means.
Yeah, I think a lot of people hear that word and they're like,
It gets thrown around a lot.
yeah, but what does it actually mean?
Inflation is simply the rate
Okay.
at which prices for goods and services increase over time,
Okay.
causing a decrease in the purchasing power of money.
So that's why my morning coffee seems to cost more every year.
It's a classic example.
Yeah.
And inflation can be driven by a variety of factors,
Right.
from increased demand to supply chain disruptions to government policies.
Is inflation always a bad thing?
That's a great question. Not necessarily.
Okay.
A moderate level of inflation
Right.
is generally considered healthy for a growing economy.
Okay.
But when inflation gets too high,
It can erode purchasing power,
right.
hurt businesses, and lead to economic instability.
So it's a delicate balance
It is.
that policymakers need to kind of manage carefully.
Exactly. And understanding how inflation works
Yeah,
is crucial for making informed financial decisions,
right.
from budgeting and saving to investing and retirement planning.
Okay, before we dive into the next batch of terms,
Okay.
let's recap what we've covered
Sounds good.
in this segment. So we started by demystifying bonds,
Yes.
those debt securities that allow you to lend money
Right.
to governments or corporations in exchange for interest payments.
Exactly.
We explored the concept of diversification
Diversification.
and how it applies to bond investing
Absolutely.
to reduce risk. Then we tackled derivatives.
Those complex financial contracts
Yeah.
that derive their value from underlying assets
Right.
and can be used for hedging or speculation.
We moved on to balance sheets,
Right.
financial statements that provide a snapshot.
A snapshot of a company's assets, liabilities, and equity.
Easy.
We explored market capitalization,
Market cap.
or market cap,
Yeah.
which is like a measure of a company's size and value.
Based on its share price
Right.
and outstanding shares.
We talked about recessions.
Nobody's favorite topic,
No.
but important to understand.
Yeah, those periods of economic decline that are kind of inevitable.
Part of the business cycle.
Yeah, exactly. We demystified hedging,
A risk management strategy.
right, designed to offset potential losses.
That's right.
And we wrapped up with a discussion of inflation.
A very timely discussion.
Yes, the rate at which prices increase over time.
That was an impressive summary.
Thank you.
You're really getting a handle on these financial terms.
I'm feeling more confident with every term we decode.
Good. I love to hear it.
But there's still so much more to explore
There is.
in this fascinating world of finance.
Yes.
Let's see what other intriguing terms are waiting to be unlocked.
Let's do it.
Welcome back to our Financial Glossary Deep Dive.
Part 3.
We've journeyed through a whole alphabet of terms,
We have.
and I'm feeling a lot more confident, you know,
That's great.
navigating this complex world of finance.
It's been quite an adventure, hasn't it?
It has.
And we're not done yet.
Okay, bring it on.
We've got a few more intriguing terms to unpack.
All right, I'm ready for the challenge.
Okay.
What's next on the agenda?
Let's talk about mutual funds,
Okay.
a popular investment option
Yeah.
that often gets mentioned alongside ETFs.
Right.
How familiar are you with mutual funds?
I've heard the term, of course, but I'm a bit fuzzy on the specifics.
Good.
You know, I know they pool money from multiple investors,
Yes.
but what exactly do they do with it?
Imagine a basket
Okay.
filled with a variety of stocks, bonds, or other assets.
Right.
A mutual fund is essentially that basket,
Okay.
managed by a professional portfolio manager.
Gotcha.
Investors buy shares of the mutual fund,
Okay.
and their money is pooled together
Right.
to purchase those assets.
So instead of picking individual stocks myself,
Yeah.
I can buy like a share of a mutual fund
Yeah.
and get like instant diversification.
That's the key advantage.
Okay.
Mutual funds offer a convenient way to diversify your portfolio,
Right.
especially if you don't have the time or expertise
Right.
to manage your investments individually.
But aren't there like fees involved?
Yes, there are management fees
Okay.
and operating expenses associated with mutual funds.
Right.
This is where the expense ratio comes in,
Oh, okay.
a term we touched upon earlier.
Right, right.
It represents the annual cost of owning a mutual fund,
Okay.
expressed as a percentage of your investment.
So lower expense ratio
Yeah.
means more of my returns are going into my pocket.
Exactly. It's an important factor to consider
Right.
when choosing among different mutual funds.
Okay, that makes sense.
Yeah.
Okay, let's talk about recession again.
A
Yeah.
word that sends chills down the spines
Yeah.
of investors and economists alike.
Yeah, we touched on this briefly before, but
Yeah.
I'm curious, like, what are the indicators that actually signal a recession?
Recessions are complex phenomena,
Right.
but some key indicators often precede them.
Okay.
One is a decline in GDP,
Right.
gross domestic product, which we discussed earlier.
Right.
It's a measure of a country's overall economic output,
Yeah.
and when it contracts for 2 consecutive quarters,
Okay.
it's generally considered a recession.
So negative GDP growth, big red flag.
It's definitely a warning sign.
Okay.
Other indicators include rising unemployment,
Right.
a decline in consumer spending,
Yeah.
and a drop in business investment.
Okay.
These factors tend to feed off each other,
Oh, okay.
creating a downward spiral of economic activity.
All right. Well, let's talk about a more fun term.
Okay.
Yield.
Everyone loves yield.
Yeah, everyone loves to hear that word.
Yeah,
Seems pretty straightforward.
it does, yeah.
But are there different types of yields?
Yield, in its simplest form, refers to the income return on an investment,
Right.
usually expressed as a percentage.
Okay.
But there are nuances to consider,
Okay.
depending on the type of investment.
So, like, what's the difference between the yield on a bond versus the yield on a stock?
A bond's yield typically refers to its annual interest payment
Okay.
relative to its price.
Okay.
So if a bond pays, $50 in interest per year,
Right.
and its price is $1,000, its yield is 5%.
Okay.
And for stocks, yield usually refers to dividends.
Right. Okay.
A stock's dividend yield is calculated by dividing
Okay.
the annual dividend payment
Right.
by the stock's current price.
Okay. So yield is all about the income an investment generates,
Okay.
whether it's interest from bonds or dividends from stocks.
Precisely. And understanding yield is crucial
Yeah.
for income-oriented investors who prioritize generating a steady stream of
Right.
cash flow from their investments.
That makes sense.
Yeah.
Okay. Volatility.
Okay.
I know it has something to do with risk,
It does.
but what does it actually measure?
Volatility is a statistical measure
Okay.
of how much an investment's price
Right.
fluctuates over time.
Okay.
A highly volatile asset experiences big price swings, both up and down,
Okay.
while a less volatile asset has more stable prices.
So a volatile stock would be like a roller coaster ride.
That's a great analogy.
Lots of ups and downs.
And investors need to consider volatility carefully
Right.
because it directly impacts their risk tolerance.
Yeah.
If you can't stomach big price swings,
Yeah.
you might want to avoid highly volatile investments.
But wouldn't higher volatility also mean like the potential for higher returns?
That's the trade-off.
Right.
Higher volatility often comes with the possibility of greater gains,
Right.
but it also means a higher risk of losses.
Yeah.
It's all about finding the right balance
Yeah.
between risk and reward
Right.
based on your individual investment goals
Okay.
and comfort level.
That makes sense. Okay. Quantitative easing.
Oh, this sounds very scientific.
It does. It sounds like a science fiction concept.
A bit like a science fiction concept.
But I know it's a real thing.
It is a real monetary policy tool.
So it's like a secret weapon that central banks deploy.
It's more like an emergency measure.
Okay.
Quantitative easing, or QE,
Right.
involves a central bank injecting money
Okay.
into the economy
Right.
by purchasing long-term assets.
Right.
Primarily government bonds.
And how does that actually stimulate the economy?
By buying these bonds, the central bank increases the money supply
Okay.
and lowers long-term interest rates.
Okay.
This encourages borrowing, spending, and investment,
Right.
which in turn helps to boost economic activity.
So it's a way to kind of pump money into the system and
And get things moving again.
yeah.
Exactly.
Yeah.
QE has been used by central banks around the world in recent years
Right.
to combat economic slowdowns and financial crises.
Right.
It's a complex and controversial tool,
Okay.
but it can be effective in certain circumstances.
Okay, before we wrap up this entire financial glossary adventure.
It has been quite the adventure.
It has been.
What a journey.
Yeah, let's recap
Okay.
the key takeaways.
Sounds great.
From this final segment. So we started with mutual funds.
Yes.
Those professionally managed baskets of investments that offer diversification and convenience for investors.
Exactly.
Then we delved deeper into the concept of recession
Recession. Yeah.
and explored like the economic indicators
Yes.
that often signal a downturn. We clarified the concept of yield,
Everyone's favorite.
the income return on an investment, whether it's interest from bonds
Right.
or dividends from stocks.
That's right.
We tackled volatility,
Volatility.
a measure of how much an investment's price fluctuates over time.
That roller coaster.
Yeah, exactly.
Up and down.
And we wrapped up with a discussion of quantitative easing.
That powerful but unconventional
Yeah, very sci-fi sounding.
monetary policy tool used by central banks
Yeah.
to stimulate the economy.
Well, I couldn't have done it without your expert guidance.
Oh, shucks.
You've broken down these intimidating terms
It's been a pleasure.
into like bite-sized pieces.
Absolutely.
And made the world of finance feel much less daunting.
That's the goal.
Yeah, and to our listeners, congratulations on completing this whole financial glossary deep dive.
Yeah, congrats, everyone.
You know, we hope you feel more informed and empowered
Absolutely.
to navigate the world of finance.
Remember, knowledge is power,
Absolutely.
especially when it comes to your finances.
Yes.
So keep learning, keep exploring,
Yeah.
and keep asking questions.
Until next time, happy investing.
Happy and
That's it for today's episode of Wealth Hustle 247. Be sure to follow, like, comment, and share with others. Keep pushing toward your goals, and we'll see you in the next episode.